Silver's recent price behavior has moved decisively beyond ordinary volatility and into territory that demands serious attention. In a remarkably short period, the metal surged to new record highs above $89 per ounce and pressed toward the $90 level. The speed and scale of this advance place it among the most aggressive moves the silver market has ever recorded. This is no longer a marginal development confined to specialist circles. It is unfolding alongside broad shifts across the precious metals landscape. Gold's performance forms part of that opening context. Gold surged as well, reinforcing the sense that capital is concentrating in hard assets. Yet, at the moment of recording, gold was slightly lower, a contrast that matters. While gold remained elevated, silver was the metal pushing hardest into new extremes. That divergence sets the tone for the discussion that follows, suggesting that silver is no longer simply tracking gold, but asserting its own momentum. One of the clearest expressions of this shift appears in the gold-to-silver ratio. As silver accelerated, the ratio compressed to 52.86, underscoring how rapidly silver has been outperforming gold. Attention has increasingly turned to the possibility of the ratio falling below 50, a level that would further emphasize silver's relative strength within the precious metals complex. The ratio is not presented as an abstract indicator, but as a direct reflection of changing price dynamics already underway. Together, these elements define the market environment. Silver near $90, gold elevated but momentarily softer, and a sharply tightening ratio established the conditions under which subsequent developments must be understood. This opening snapshot explains why institutional decisions and physical availability suddenly carry far greater weight. The move itself is defined by how far and how fast silver has traveled. Prices did not merely revisit old highs, they pushed into uncharted territory above $89 and approached $90. That distinction matters because familiar reference points disappear, leaving little historical resistance to guide the market. The advance is described not as a gradual climb, but as a decisive surge compressed into a narrow window of time. Gold's behavior during this period provides an important counterbalance. Gold moved higher alongside silver, confirming strength across precious metals. However, its slight pullback at the time of recording highlights that silver was driving momentum. The contrast reinforces the idea that silver's rally was not a passive echo of gold, but a move with its own intensity. The compression of the gold-to-silver ratio captures this relationship numerically. As silver surged, the ratio narrowed to 52.86, signaling how much faster silver was rising. The possibility of a move below 50 is framed not as a forecast, but as a logical extension of changes already visible in the market. These record levels and ratio dynamics elevate the significance of the rally. Silver is reclaiming attention and challenging long-standing hierarchies within precious metals. With price action entering unexplored territory and relative strength accelerating, institutional responses take on outsized importance. Against this backdrop, the first major institutional response highlighted comes from the CME Group. Effective January 13, 2026, the exchange will shift precious metals margin calculations from fixed dollar amounts to a percentage-based framework. The change applies directly to gold and silver futures, linking required collateral more closely to price levels. Under the new structure, gold margins are set at 5%, while silver margins are set at 9%. This is presented not as a technical adjustment, but as a meaningful recalibration. As prices rise, the amount of capital required to hold positions rises proportionally. In a market already trading near record highs, that shift carries immediate consequences. Timing is central to the impact. The margin changes arrive precisely as silver is testing historic levels and investment interest is intensifying. In this context, percentage-based margins are not neutral. They directly increase cash demands on participants already exposed to extreme price movement, folding exchange policy into the same narrative as the rally itself. The episode frames this not as an isolated decision, but as a structural response to extraordinary conditions. As prices surge, the mechanics governing participation in futures markets are being recalibrated in real time, setting the stage for secondary effects beyond simple compliance. Those effects emerge most clearly in how higher margins interact with existing positions. With silver margins at 9%, maintaining exposure becomes increasingly capital intensive as prices climb. This creates pressure for participants relying on leverage, particularly producers, who hedge by holding short futures positions. As prices rise and margin requirements escalate in tandem, these hedges require additional cash to remain open. The episode emphasizes that some producers may be forced to unwind short positions, not because their production outlook has changed, but because collateral requirements become more difficult to meet. This introduces a financial constraint independent of long-term fundamentals. If hedging shorts are reduced or closed, selling pressure embedded in the market structure is removed. The episode presents this as a potential source of bullish pressure, grounded in mechanics rather than speculation. The focus remains on how rules interact with positioning during extreme price conditions. The discussion then shifts to a second CME action that moves in the opposite direction: product expansion. The exchange announced the launch of a new 100-ounce silver futures contract aimed specifically at retail investors. This product is positioned as a response to unprecedented investment demand that has intensified alongside the price surge. Unlike traditional contracts, the new instrument is cash settled only. There's no option for physical delivery. That distinction is explicit. The contract offers price exposure without requiring access to or handling of physical metal, lowering both logistical and financial barriers to participation. The timing is presented as deliberate. Launching a retail-focused contract as silver approaches $90 aligns with heightened public attention. The exchange is channeling that interest into a standardized, accessible product, expanding participation even as other mechanisms tighten. The cash-settle design defines how the contract fits into the broader market. Settlement occurs purely in cash, detached from sourcing, storage, or transfer of silver. The contract tracks price, not metal. Its relevance lies in structure and timing, not in any effect on physical supply. Placed alongside higher margin requirements, the new contract illustrates a dual response to the same conditions. Participation becomes more expensive in some areas and more accessible in others. Together, these changes show how the exchange adapts when price levels and investor interest reach extremes. To contextualize the move, the episode points to a prior gold precedent. When gold prices rose sharply, the CME introduced similar products to accommodate elevated prices and broader participation. The comparison is restrained, used not to equate outcomes, but to normalize the decision-making process. This framing positions the silver contract as part of an established pattern rather than an improvised response. As metals enter higher price regimes, the exchange adjusts its offerings accordingly. Silver is now following a familiar institutional pathway. Attention then shifts away from futures and toward the physical market, where an unexpected development emerges. The United States Mint is identified as a surprising source of favorable pricing. Even as silver trades near record highs, specific products are highlighted. Presidential metals were available with unusually low premiums, in some cases close to spot price. In a market where premiums typically expand during rapid price moves, this stood out as an anomaly rather than a norm. This occurred even as the Mint announced pricing adjustments for numismatic products due to higher metal costs. That contrast made the availability of near-spot offerings more striking, suggesting uneven transmission of price pressure across product lines. The episode clarifies that this situation was transitional. Sales of Silver Eagles had already been suspended, signaling tightening conditions. Other products remained available, but with clear indications that price increases were forthcoming. These details complete the picture of how rising silver prices ripple through institutions. Futures exchanges adjust rules and launch new instruments, while the National Mint recalibrates pricing and restricts access. The changes do not arrive simultaneously, but they all respond to the same reality. Taken together, these developments depict a market operating under exceptional stress. Silver's rapid advance above $89, gold's elevated position, and the compression of the gold-to-silver ratio establish the intensity of the moment. Institutional responses amplify that significance. Higher margins reshape positioning, new contracts broaden access, and physical availability tightens unevenly. The episode closes not with prediction, but with synthesis. Silver has entered a range that forces adjustment. Price action, rule changes, product launches, and shifting availability are all interconnected responses to a single underlying fact. Silver is no longer behaving like a secondary metal. It is driving the structure of the market itself.